Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, podcast listeners, to the Absolute Return Podcast. I'm your host, Julian Klimachko. I'm joined by my co-host, Mike Kesslering. And on today's show, we welcome special guest, Matthew Tuttle, CEO and Chief Investment Officer of Tuttle Capital Management. Now, Tuttle Capital Management is an industry leader in offering thematic and actively managed ETFs. On the show, Matthew discusses his outlook on the current market environment and asset allocation, how to play pre-deal SPACs and deSPACs, trend following, Fomo, and tail risk strategies, his top investment pick for the next decade, and more. So with no further ado, here's our podcast with Matthew Tuttle, CEO and Chief Investment Officer of Tuttle Capital Management. Hey, Matthew, welcome to the podcast. Happy to have you on the show today to talk about all things markets and what's going on out there, ETF land, SPACs, of course, and some additional investment strategies that you're offering to investors. But before we get into all the good investing stuff and what's going on in the current market environment, I mean, you've been in this business, the investing business, for over 20 years, financial services. You had a stint in fixed income sales at Bear Stearns in the late 1990s. Could you walk us a bit through your career and the background of Tuttle Capital Management and what you're up to there?
Yeah, so and at the risk of dating myself, it's actually more like 30 years.
Oh, nice.
I'm kind of an old fart. Started out in working for a division of State Street Bank, and working in with closed-end funds for the most part, and always planned on kind of being there, getting an MBA part-time, going to work, and being a mutual fund manager.
Yep.
And unfortunately, they kept promoting me, and I never had time for business school. Finally, decided the only way I was going to do it was just pull the plug. Left, went, got my MBA full-time. Went to work for Bear Stearns in fixed income sales. Hated it. It just, looking back, I realized it just wasn't entrepreneurial in any way, shape, or form.
What did you hate about it? Was it just too constrained, or?
Yeah, I mean, basically just, I didn't know at the time, but I'm an entrepreneurial type of person. I can't have a boss. And, I had 3 bosses who took the idea of being a boss very seriously.
Right.
And I bristled against that. Again, I didn't realize that at the time. I mean, looking back on it, it's like, oh, yeah, I can't work for anyone. And I was working for 3 people who all were very opinionated about things. So that didn't turn out that well. I then went to work for a couple of different brokerage firms. Was really appalled by what passed for financial advice. Tried a couple of different insurance companies. Was equally appalled at what passed for financial advice. Didn't really realize there was another route to things. And in 2003, a friend of mine gave me a book, a step-by-step guide to setting up your own RIA.
Okay.
I read it, and within a couple of weeks, I had my own RIA. That was 2003. By around 2012, we started having other wealth. So we were in the wealth management business. We started having other wealth managers come to us and say, hey, we see what you're doing on the money management side of things. Could you do that for us and be kind of our outsourced chief investment officer?
Yeah.
And I said, fine. But one of them said, look, Matt, we're kind of right down the street from each other. I'm sort of uncomfortable given you're a competitor. I said, all right, here's what I'll do. I'll set up a money management arm. You go to the website, it won't say anything about wealth management. They were cool with that. fast forward a couple of years later, I mean, we've always been pretty active in our trading, was really bristling at trading through custodial platforms, the Fidelities, the Schwabs, the TDs. So someone gave us the idea of, hey, why don't you just start ETFs? Right. That way you can trade with what any broker you want. That sounds like a great idea. So we started launching ETFs. Eventually got rid of our wealth management business. We ended up giving it to one of our ETF clients. And we've been launching ETFs for ourselves. Then we started having other people coming to us saying, hey, can you launch ETFs for us? Yeah, we can do that too. And that's kind of where we are. So today we've got 10 ETFs that are out there right now in the marketplace. We've got another 7 or so in various forms of registration. And then there's another 3 that will be coming fairly shortly. So by the end of the year, we should have at least 20 ETFs out there and maybe more.
And now, a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate Arbitrage Fund, symbol ARB on the TSX, is the world's first SPAC-focused ETF with a diversified portfolio of SPAC and merger arbitrage opportunities in an easy-to-use, low-cost ETF. The Accelerate Arbitrage Fund ETF trades under the symbol ARB on the Toronto Stock Exchange. Find out more at accelerateshares.com.
So obviously, I mean, your business model is in structuring ETFs. This has been a prevailing trend over the last number of years. What, in your opinion, what's really driving the move from mutual funds to ETFs? And just to add context to that, in Canada, that's happening to some extent, but to a far lesser extent than in the U.S. What's really driving that in the U.S.?
There's a lot of things there. One is fees. Your actively managed mutual fund typically is definitely going to cost more than an index ETF. It is typically going to cost more than an actively managed ETF. Number 2 is the fact that, most actively managed ETFs here don't beat the S&P 500. So it's kind of, so I'm paying 1.5% to not beat something that I could pay 9 basis points for. That doesn't make sense. There's the tax efficiency of ETFs, the things ETF managers can do to mitigate capital gains taxes you can't do in a mutual fund. There's the fact you can trade ETFs intraday. You don't have, 60-day holds on ETFs. I can buy, an ETF in the morning and sell it in the afternoon and buy it back later in the day, and no one's going to yell at me. And then what you've really had since COVID is you've had this kind of striation in the U.S. market where people are kind of flowing towards core and satellite, right, where they're looking at, the cheap beta as the core of their portfolio. And then what they're looking for is thematic stuff to go around the cheap beta. And that kind of leaves your average kind of active index hugging mutual fund manager they don't fit into that model at all.
Right.
So I really do think, mutual funds are an endangered species here.
Yeah, it seems like that is the case. You see it in the fund flows each and every month and quarter and year, and it just seems to be getting worse and worse. But getting into the money management side, obviously ETFs have been a massive growth area. You got 10 in the market, a number in the hopper that should be up shortly. I wanted to understand, what are your thoughts on the current market environment? Very low bond yields, investors having a real tough time generating that income that they like. And then on the equity side, specifically U.S. equities, sky-high valuations. What's an investor to do?
So a lot of different things. What you're seeing, and the past couple of days are a great example, there is no alternative.
Right.
Market sold off on Monday. Everyone in the media, oh my God, this is the beginning of the end. Correction, everything's going to blow up. And, now we're back higher than we were to begin with. And there is no alternative. Interest rates are still extremely low. The economy is recovering. Things are getting back to normal. Slowly but surely, earnings are blowouts. So really what's an investor to do is kind of what they're doing, put cheap beta in the core of your portfolio, put some thematic stuff around it, have some tail risk protection.
Right.
And, on the bond side, look at absolute return types of bond strategies, or just replace bonds entirely with, tail risk or SPACs, things of that nature, because, treasury bonds here don't make a whole heck of a lot of sense to me from a longer term investor standpoint.
Oh, totally. And you hear that each and every day. Oh, these treasury yields are way too low. How the heck can I generate income? And you mentioned, SPACs or these other sort of alternative asset classes. And one method of doing that, and specifically looking at your product shelf, you have strategies focused on both pre-deal SPACs and deSPACs, including both long and short, which is a super interesting way of taking a crack at it. What are your thoughts on, first, I got a number of questions on SPACs. So first, what are your thoughts on the pre-deal SPAC market? How are you looking at that part of the asset class?
So the pre-deal SPAC market is settling in to where it's supposed to be.
Right.
Earlier in the year, you had, the Reddit guys, the Wall Street Bet guys jumping in thinking that pre-merger SPACs were like AMC and GameStop. And
Dogecoin too.
And you and I know they're not. What should $10 in trust with an experienced management team looking for a deal, what should it be trading for?
Mm-hmm.
I don't know. Should it be trading for 20 or 30? I would argue it shouldn't.
Yeah.
But, you were seeing some of this ridiculous stuff out there. And then, CCIV kind of was the, put an end to all that. But now what you're seeing is SPAC settling in to what they should be, which is an event-driven strategy that has low correlation to stocks and bonds, that fits into pretty much any investor's portfolio for a 10 to 20% piece. And I would argue it fits in a lot like people are using merger arbitrage funds here.
Yeah.
But I would argue that a well-run SPAC strategy has more potential upside than merger arbitrage does. And I've got one of my analysts writing a paper on this, and I just kind of looked back. Our fund wasn't around during COVID, but I just said, hey, what if we took a portfolio of SPACs and owned them? And I think during the COVID crisis, we would have lost 2%. And I ran like the biggest merger arb ETF down here, and it would have lost like 20.
Yeah.
So, to me, down 2 is a whole lot better if you're putting in something diversified into your portfolio than, down 20. So, I really am positive on the pre-merger SPAC marketplace is something that, can benefit every investor's portfolio. That being said, are there too many SPACs chasing too few deals? Yeah. Or a lot of these deals going to be awful? Probably. So, it's not as simple, and nothing ever is. It's just, hey, I'm going to buy a bunch. You need an actively managed strategy that's looking at valuations, looking at management teams, looking at track records. But if you do that, I think pre-merger SPACs are a great strategy.
And you really hit the nail on the head with respect to the low risk profile and the uncorrelated nature, low drawdown risk, as long, and this is the most important piece of it, as long as they're buying at the right price. And so investors should certainly be aware of your warning, and we try to give the same warning. You don't want to pay insane prices for, $10 and change of cash and trust, for a potential deal and a dream as it may be. Now, you indicated many, many SPACs out there. Of course, there's nearly 600, a lot of business combinations getting announced. Now, you guys have plays on both the long and short side of the deSPACs. What are your thoughts on this market and how do you approach it?
So the deSPAC market, so to me, the pre-merger stuff, it's kind of stodgy and boring.
Yep.
I love it, but compared to the deSPAC market, the deSPAC market, that's interesting stuff.
It's the Wild West.
You turn on CNBC every day, they're talking about at least one deSPAC company, Clover, Lordstown Motors, QuantumScape, SoFi, on and on. So there's a lot of interesting stuff there. And I don't find myself agreeing with Jim Cramer a ton, but I remember he said something along the lines of, hey, just buy a portfolio of these deSPAC companies, put it away, don't look at it. Don't make it a big part of your portfolio, but take a small part of your portfolio, buy a bunch of these deSPACs, put it away, don't look at it. And some of them are zeros, but some of them are going to go up so much that, it's going to more than offset the ones that go to zero. And I think that makes a lot of sense. There are a lot of companies that, are in the extreme early stages that you can get access to here. And who knows? There could be the next Tesla, there could be the next Amazon, there could be the next whatever in here. Also with the understanding that, this is pre-revenue stuff for the most part. It's going to be a wild ride. And some of them are zeros, but we really built the long side DSPC for someone to be able to say, all right, look, I'm going to put 2-3% of my portfolio in it, and I'm going to shove it away, and I'm not going to look at it. And you don't want to look at it because this stuff is a wild ride.
Yeah, volatile.
So the short side, we really built more because we were talking to a lot of institutions about our SPAC strategy, and and they loved it. And people kept saying, hey, we're trying to short some of these deSPACs, and it's a pain in the butt. They're hard to borrow. You get short squeezes. Clover a couple of weeks ago was up like 93% in a day.
Insane.
If you were short that, that wouldn't have been a really good day for you. So we said, all right, you know what? There's a lot of demand out there to short these companies. And why don't we create a product around that? So we did the work, and it's a lot of work. But it was worth it. The fund's been pretty popular. Last time I looked, it was the top performing ETF month to date. Before today, it was up like 20% or something for the first 3 weeks of the month. So, again, it's an index that's going to move, and deSPACs have had a really bad month. So, that's why we built that, so that people could, and there are a lot of people who want to short these names who can't short. I've heard from people, hey, I'm trying to buy puts and my broker's giving me a hard time. So we just wanted to make it easy for people. You don't have to worry about short squeezes. You buy one thing, you can pretty much buy it anywhere. So that's the idea behind the deSPAC product.
And now a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate One Choice Alternative Portfolio ETF, symbol 1C, ONEC on the TSX is Canada's first alternatives portfolio solution, providing exposure to 6 alternative asset classes, 10 alternative strategies in one easy-to-use, one-choice ETF that charges a management fee of just 0.2%. The Accelerate One Choice Alternative Portfolio ETF trades under the symbol 1C ONEC on the Toronto Stock Exchange. Find out more at accelerateshares.com.
Yeah, it's very interesting. I mean, on the long side, certainly very similar to VC type investing, where you're looking for a few names to basically return the fund in a VC fund in their LP structure. But then as well, with both the long and short, investors can even build their own long short strategy with the funds, which is quite interesting. When you've kind of touched on it a little bit, but I guess you've talked about a few individual elements of the SPAC market. Do you have any additional views on the entirety of the SPAC ecosystem moving forward?
So, I mean, obviously the SEC, put a speed bump in there, and, things haven't totally come back from that. We're in a much better spot than we were a couple of months ago. IPOs are coming back. Deals are going through, but you've still got, a bunch of SPACs trading under 10, some well under 10. So, we're not back there yet. There's still a stigma. I don't think yet that the retail and the advisory community have caught on to kind of, hey, look, these aren't a meme stock. These are, a non-correlated event-driven asset class that actually do belong in your portfolio. Brokerage firms, a lot of them down here still won't allow people to buy SPACs. They'll allow you to buy, AMC and GameStop, but you can't buy, a SPAC that's trading at $9.80 that has $10 in trust because, oh no, that's too risky, Mr. Client. So, there's still that stigma. There's still kind of that lack of understanding. And I think a lot of times the media does a really poor job of, everything is a SPAC. I mean, I don't know about you guys, but, when I'm watching TV and someone's saying, oh, the SPAC market's getting killed today. Look at Lordstown Motors. Like, dude, that's not a SPAC. It's a deSPAC. Yeah. And I'm looking at SPCX and I'm like, no, we're having a good day today. The SPAC market is not getting killed. Lordstown Motors is getting killed because they make no money and there's some weird stuff going on with their financial statements. That has nothing to do with the SPAC market. So you still have these misconceptions out there that, hopefully one day this will be just a normal thing that, that people don't have those misconceptions about. So, we're constructive on the market. I like where it is now versus where it was a couple of months ago. And I do like where it is now versus where it was in February. Because, I mean, we didn't have really anything to buy back in February. I mean, we're looking at this stuff, we're like, it's a good management team. These guys have a good track record. We love what they're doing, but we're not going to buy this for 16. It just doesn't make any sense.
Yeah, and that was a difficult time to allocate capital because every SPAC was trading at a premium, and IPO allocations were tough to come by, given every single deal was basically 20x oversubscribed with the Millenniums and Citadels of the world coming in.
We were offering our firstborn kids to get allocations in IPOs, and now brokers call us for IPOs and we don't answer the phone. I'll just buy it at $9.90 when it trades in the secondary market.
No doubt.
I mean, why am I going to get it at 10?
For sure. And moving beyond SPACs, I mean, you have a number of strategy pre-deal or deSPACs, but you have some additional asset classes that you take a look at. I was interested, one caught my eye, Fomo. How does that strategy work?
So what Fomo is kind of our answer to what's going on in thematic investing. So, money is flowing into it. I mean, people want this stuff, but the way it's being done, I think is wrong. So what people will do is, we'll we'll slap an index on something like, fuel cells or solar, or social media buzz. I mean, you name it, we'll slap an index on it. We'll rebalance it infrequently. We'll have large holdings in some individual stocks that, if we hit, pump the return up a lot. But if they go down, that sort of sucks the other way. And I just, I thought that, A, that was just way too rigid, and B, way too risky, and C, you weren't rebalancing frequently enough to stay in harm. So what we do in Fomo is we start off with kind of the universe of what should be in Fomo. And that can be a moving target. So, I mean, right now, to me, it's stuff that's popular with retail guys. It's stuff that's popular with hedge funds, and it's innovative technology. 6 months from now, maybe it's going to be something else. Who knows? Maybe inflation plays will get in there. Maybe infrastructure will get in there. Right now we capture that with the hedge fund and the retail stuff, but that can be a moving target. So we can change as society changes. Whereas if I'm stuck in an index, the index is the index. Then what we do is we're looking to stay in harmony with kind of the trend. So we kind of split the basket in two, and half of it we're looking for the stocks that are in the strongest uptrend. And the other half of it, we're saying, all right, give us the stocks that have been in the strongest uptrend, but have recently sold off. Because if all I did was just had a group of, the momentum stocks, most of the time that's great. Every once in a while, they take the momentum stocks out and they shoot them.
Yep.
And they go down a lot. But when that happens, where does the money go? The money goes into what had been hot, but has been selling off recently. So what I found is by including kind of this counter trend analysis in what we do, it really ends up smoothing out the return. And then we'll do our analysis on a weekly basis. So we're able to really stay in harmony with what's going on in the market. So, if I'm buying into, AMC at the beginning of the month, and AMC is really, all the Wall Street bet guys are off to something else, and now AMC starts trading on fundamentals, I don't have to wait a whole month or a quarter or 6 months to get out of it. We'll be out of it. All right, fine. I got into it Monday. You know what? I'm out of it next month.
Now, with respect to diversification and asset allocation, most investors obviously own stocks. Some will diversify with bonds, but obviously just two asset classes. That really isn't diversification, which includes theoretically uncorrelated assets or even negatively correlated assets. One strategy that I'm a fan of is that of tail risk, which is theoretically negatively correlated. It can do well when the market sells off. Typically a tough sell when beta is working so well, but then it becomes very popular after the market crashes. I understand you have a tail risk strategy. I was wondering, how does it work and how should investors use it?
So what we're trying to do there, so that's our FAT T ETF. And what we're trying to do there is have what I would call positive carry tail risk.
Right.
The problem that you've had with tail risk strategies in the past is they bleed, and they bleed a lot. So, the story coming out of 2008 was, hey, Mr. Portfolio Manager, put this in your portfolio because you don't know when a tail risk event is going to happen. It's going to cost you 3 to 4% a year. But if we have another 2008 again, man, you're going to be a hero.
Yeah.
So, all right, great. I had a near-death experience in 2008. Sounds good. I'll give up return. And we don't have another 2008. So, I saw a story that CalPERS and actually some pension fund in Canada had tail risk strategies that they got rid of in February 2020, right before the COVID crash, because they couldn't handle the bleed anymore. So the idea behind FAT T is we want the ability to make money the 99% of the time the market's going up. Not a lot. If the market's up 30, if that tees up 5, I'm a happy guy. That's kind of the goal. And then in a crash, like a COVID event in 2008, the goal is to make as much on the downside or on the upside as the market is down. And so how we do that is we go long volatility. We own volatility in the portfolio because if you think about your typical investor's portfolio, everything they own goes down when volatility goes up, or almost everything they own. So when we're looking at kind of negative correlation, how can we guarantee that we've got something in a portfolio that's going to go up when volatility goes up? And that's owning volatility. And then we cut it by owning index ETFs. And the idea is that while the market's going up, the index ETFs are going up, obviously, and the volatility is bleeding to the downside. So we're getting some upside, which is being cut into somewhat by the volatility. When volatility spikes, it goes up way more than the indexes go down. So for example, during COVID, if you owned a VIX exchange traded product, at one point you were up 300% when the market was down like 30. So that gives you kind of the difference. So the way the portfolio is managed is our volatility position moves up and down. We'll always own some volatility, but it's going to move up and down based on kind of what's going on in the market. So all of last week, we were slowly buying volatility. And now as the market is selling off, we're now bringing that volatility position back down.
So you spoke a little bit about your background at the beginning, but I was curious, who have been some of the important mentors that you've had throughout your career?
So really two important ones. Early on, I had a business school professor, Professor Heisler, who, I will never forget. He's teaching, modern portfolio theory, and we're going through and constructing optimizers and all this stuff. And we got to know each other. And he pulled me aside one day. He's like, look, I'm only teaching this stuff because I have to. All of this stuff is bull. None of it really works. It's garbage in, garbage out. And he was telling me how he developed, an adaptive moving average crossover system to trade currencies that he ended up selling to a hedge fund. So I was fascinated by that. I went home. I mean, this was like mid 90s. So I'm pretty sure I had Excel. I had access to some data. So I just kind of, how would I try to construct this? And I basically constructed an adaptive moving average crossover system, applied it to a series on the British pound. I was like, oh my God, this is amazing. I mean, this gets you in when it starts going up and it gets you out as it starts to go down. This is great. I mean, that was just fascinating. And then later on, a guy, Murray Ruggiero Jr., smartest guy I've ever met, maybe the smartest guy on the planet. He was designing neural networks back before people knew what neural networks were, worked with a lot of kind of the famous people in the trading community, knew everything about kind of technicals and intermarket analysis, just a complete genius. Unfortunately passed away a couple of weeks ago. But his son, who was on the line earlier thinking that this was a call he had to be on, is actually my head trader. So I think those are the two biggest influences I've had.
All right, great. And Matthew, prior to wrapping things up, I got one last question for you. If you could hold just one investment for the next decade, what would it be and why?
One investment for the next decade.
Yeah.
I would say for the next decade, it would be deSPAC, our long deSPAC. As long as I didn't have to look at it intraday, I think 10 years from now, that's going to be ridiculous. But not looking at it is the key.
Yeah.
As long as I don't have to look at it 10 years from now, that thing's going to be a monster.
putting those deSPAC in a lockbox and not opening it for a decade. It's tough to do, but if you can do it, then
yeah. I mean, it's down 18% this month, so yeah, you can't look at it day to day.
Yeah, those things.
10 years from now, yeah, totally.
They certainly are volatile. So where can investors find out more? You got social media, website. What else you got going on?
So yeah, I mean, I'm on Twitter at Tuttle Cap. I'm on LinkedIn. Our website, tuttlecap.com. That you can find me in any of those places.
Okay, perfect. Well, thanks so much, Matthew, for coming on the show. Interested in hearing your market insights, SPACs, Fomo, tail risk, and more. So we wish you the best, and we'll keep in touch.
All right. Thanks for having me.
All right. Bye, everybody.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.